The stock market is currently closed, and the latest closing price for Datavault AI Inc., trading under the ticker symbol DVLT on the NASDAQ, stands at exactly $0.4065 as of the final closing bell on June 18, 2026. During that last active trading session, the stock managed a minor positive intraday movement of 0.99%, ticking upward by just a fraction of a cent. While a green day typically brings a sigh of relief to retail investors scouring various investing sites for cheap entry points, the reality beneath this tiny bounce is an absolute pressure cooker. Just as the market wrapped up this session, news broke that the prominent Pomerantz law firm has officially launched a formal investigation into the company for potential securities fraud and unlawful business practices. This legal inquiry stems directly from deep structural accusations that the firm is essentially a promotional vehicle operating on empty claims regarding artificial intelligence, blockchain ledgers, and tokenization. When a stock is hovering in the penny territory, a regulatory shadow like this creates an immediate structural rift between what retail bulls expect and what the financial plumbing actually reveals. To understand why this gap matters, we have to look at the common narrative surrounding small-cap technology investments right now. The general consensus among retail traders using the Robinhood app or tracking social sentiment is that anything with artificial intelligence in its name has a built-in lottery ticket potential. People look at the massive market cycles that lifted Nvidia stock or pushed Apple stock into multi-trillion-dollar territory and assume that a 40-cent microcap can easily pull off a massive recovery. The expectation is that because the company claims to possess unique patents in tokenomics and digital asset security, it is only a matter of time before a major corporate partnership or a sudden retail short squeeze sends the price back towards its 52-week high of $4.10. However, the contrarian view, backed by rigid cash flow analysis, tells a completely different story. The reality is that name changes and buzzword alignment do not automatically generate operational cash flow, and when you peel back the corporate presentations, you find a business that is burning capital at an unsustainable pace while fighting off severe skepticism from institutional research groups. Let us analyze the actual trading mechanics and recent price swings that have defined this asset over the first half of this year. Looking back at the quarterly filings from earlier in May, the company posted a net loss of $53 million for the single quarter ending in March, achieved on a total revenue base of a mere $3.42 million. When your net profit margin reads as a negative 5,794%, it implies that the core operational framework is incredibly expensive to maintain relative to the commercial traction it generates. Self-investing individuals who manage their own capital through an individual brokerage account often overlook these severe structural deficits in favor of daily volume spikes. For instance, in early June, we observed massive daily trading volume surpassing 60 million shares in a single session, causing rapid double-digit swings. Traders executing orders on the Interactive Brokers platform or using the Fidelity mobile app witnessed the price careen from over 50 cents down into the high 30-cent range within a matter of days. This intense volatility is not driven by stable institutional accumulation. It is the classic hallmark of high-frequency retail speculation and algorithmic churning. When you evaluate the ownership structure, the divergence between institutional capital and retail enthusiasm becomes even more stark. Major managed platforms like Schwab Intelligent Portfolios or corporate automated systems generally place strict market capitalization and price filters that prevent automated capital from touching stocks trading below $5, let alone below 50 cents. Institutional wealth management teams managing broad Fidelity ETFs or conservative Fidelity mutual funds require a level of financial stability and regulatory clarity that this company simply does not provide at this stage. According to recent ownership records, over 62% of the outstanding shares are held by public retail investors and smaller independent traders, leaving the stock highly exposed to shifts in retail sentiment. When a company is predominantly owned by the retail public, any piece of negative news like the recent Wolfpack short report triggers a cascading wave of panic selling because there's no institutional floor to absorb the blow. For anyone engaging in active online investing, relying on retail sentiment alone without analyzing who holds the paper is an incredibly risky proposition. To put these recent market movements into context, it helps to examine what this entity actually does and where it came from. The company was originally incorporated back in 2010 and operated under the name Summit Semiconductor for a long time before officially changing its corporate identity to Datavault AI Inc. in February of 2025. Based out of Beaverton, Oregon, its stated business model centers around providing data monetization, digital engagement, and real-world asset tokenization technologies. They have recently attempted to establish a footprint in the healthcare sector by announcing an expanded partnership with Wellgistics Health to build a blockchain-powered healthcare-as-a-service asset.
On paper, combining blockchain, healthcare data, and artificial intelligence sounds like the ultimate recipe for attracting online investment capital. But the core tension lies in execution. The company has consistently stated that its full-year revenue targets are heavily weighted towards the second half of the year, relying heavily on the pending passage of specific regulatory frameworks like the Clarity Act to validate their tokenization infrastructure. If we step back and look at the broader technology landscape, the contrast becomes even more evident. Investors looking for legitimate tech exposure are actively allocating funds across major tech assets, checking the daily movements of Tesla stock or adjusting their long-term holdings in traditional Fidelity IRAs. The broader sector has been propelled by actual enterprise software adoption and physical infrastructure deployment. When sophisticated market participants use the Interactive Brokers trading platform to analyze tech sector valuations, they compare price-to-sales ratios and cash burn rates. This asset currently trades at an incredibly volatile valuation, and while its price-to-book ratio looks deceptively low at around 1.0, the underlying assets are highly intangible and tied up in proprietary software platforms that have yet to secure widespread commercial adoption. This creates a scenario where self-directed accounts on investing sites are essentially buying into a narrative, whereas the broader market is demanding realized earnings. This brings us to a crucial point regarding how independent traders view this specific asset class. Comment below how many shares of Datavault AI Inc. you currently hold, or if you prefer to steer clear of microcap technology stocks entirely in the current economic climate. Listening to the community forums reveals a massive division. On one hand, you have passionate individuals posting highly optimistic price targets on the internet, pointing to technical chart setups like double bottoms or wave formations that suggest a rapid rebound to $3 or $4 per share. On the other hand, seasoned short sellers and risk managers utilizing professional tools like Interactive Brokers fees calculators see an asset that is highly susceptible to dilutive private placements. The company recently highlighted that it maintains a certain level of working capital through private placements, but for regular retail investors, those private placements often mean that new shares are being introduced into the market, diluting the value of the shares held within a standard Fidelity brokerage account. Looking forward, there are a few distinct paths the stock could take, and each depends heavily on whether reality can catch up to the corporate narrative. The absolute best-case scenario for the bulls rests on two major catalysts. First, the company must successfully execute its ambitious infrastructure rollout and demonstrate that its blockchain platform is handling actual revenue-generating transaction volumes rather than just processing test tokens. Second, they desperately need a favorable shift in the regulatory environment regarding digital asset credentialing. If they can surprise the market by hitting their stated financial guidance in the back half of the year, the stock could experience an explosive short squeeze, rewarding those who utilize specialized SoFi investing options or aggressive Robinhood stock trading strategies. However, the downside risks are exceptionally heavy. If the law firm investigations yield evidence of systemic misrepresentation, or if the court system validates the short report claims regarding low platform activity, the stock faces the very real threat of delisting or further compression towards its 52-week low of 25 cents. For individuals who choose to navigate these turbulent waters, the choice of platform and execution speed matters immensely. Active traders looking to capitalize on these microcent movements often rely on specialized tools, exploring advanced interfaces like the SoFi trading platform or using the specific execution routing available through Interactive Brokers account structures. Because penny stocks suffer from wide bid-ask spreads and sudden liquidity droughts, a trader attempting to enter or exit a position through standard online investing tools can easily get trapped if the order isn't executed correctly. This is why institutional money stays far away, preferring the liquidity of megacaps or highly regulated index products. When an individual manages their own portfolio via independent choices, the temptation to chase a 40-cent stock is driven by the dream of turning a small sum into a significant fortune. But the underlying mathematical reality of these microcaps involve navigating intense capital dilution and corporate restructuring that rarely favors the common shareholder. For the modern market participant, balancing the speculative urge with fundamental risk management is the ultimate test of survival. When you examine the choices available for managing a portfolio today, the market offers an unprecedented array of tools designed to guide capital. Retail participants can opt for the streamlined interface of the Robinhood app to execute quick trades, or they can seek institutional-grade investment help by utilizing automated asset allocation models like Schwab Intelligent Portfolios to build a diversified defensive moat. Those who prefer a more hands-on approach often deploy their capital through dedicated online investment vehicles, choosing to invest online via trusted platforms that offer low-cost access to broad market sectors. The availability of these tools means that no one has to trade in the dark. By comparing the operational reality of speculative microcaps against the relative stability of established giants, a self-directed investor can better understand whether a 40-cent stock represents a legitimate ground floor opportunity or a dangerous value trap designed to erode retail wealth. Navigating the mechanics of modern market platforms requires a clear understanding of what each individual brokerage brings to the table. For instance, traders focused on long-term wealth preservation frequently lean towards established giants, using a Fidelity trading platform or maintaining dedicated assets inside Fidelity investments to capture steady sector growth. These platforms provide extensive research reports that allow individuals to evaluate the exact relationship between corporate debt and revenue generation. On the flip side, shorter-term market players looking for rapid execution might prefer the dynamic features of the SoFi trading platform, or use specific options within SoFi Active Investing to hedge against sudden downside turns. When a speculative asset like this company experiences a massive volume spike, the difference between a high-fee broker and an optimized platform can dramatically impact the net return on a trade. Understanding the subtle nuances of interactive broker stock trading fees versus the zero commission structure of Robinhood investments is vital for anyone trying to extract value from microcap fluctuations. When we consider the broader implications of these corporate shifts, it becomes clear that retail expectations are frequently out of sync with structural reality. The promise of asset tokenization and blockchain integration sounds incredibly modern, leading many to believe that smaller firms can easily disrupt traditional financial models. This belief drives a continuous stream of capital into risky penny stocks through various Robinhood stock trading channels or specialized SoFi stocks portfolios. Yet the corporate history of entities that undergo rapid rebranding from semiconductor hardware to abstract software solutions suggests that the transition is rarely smooth. Institutional analysts tracking the